Good afternoon and welcome to the Camarda Wealth channel. I'm your host, Troy Lerche, bringing you the Week in Wealth. I wanted to update you a little bit about the CAPE indicator. The CAPE indicator actually went down a little bit this last week, down to 37.99 from 38.36 last week. We have the bull bear indicator, which is still in cyclical bull territory. And currently we still have all four of our 404 indicators are still positive. In the US markets last week, they finished the week lower, but the large cap S&P 500 and NASDAQ hit intraday highs midweek before pulling back. And the small cap Russell 2000 underperformed for the third consecutive week. The technology heavy NASDAQ retraced all of last week's gains and ended up down 1.9%. By market cap, large caps retreated 1%, mid caps retreated 3.3%, and small caps retreated 5.1% last week. In international markets, Canada's TSX finished down 1.3%, while United Kingdom's FTSE 100 gave up 1.6%. In categorizing international markets, the developed international markets declined 1.6%, and emerging markets ticked up a tad, just at 0.1%. In commodities, precious metals finished the week mixed. Gold rose for the fourth consecutive week, and silver retreated 1.7%. Energy also retreated for the second straight week, whereas West Texas Intermediate crude pulled back 4% to 71.56 a barrel, and the industrial metal copper finished down 0.5%. Across the nation, across the nation's small business owners are raising wages, but skilled workers remain hard to find. A record number of firms, they raised wages and benefits in an effort to lower new hires to retain valued employees, but even that wasn't enough. Businesses say their biggest problem is the lack of quality workers and higher labor costs. The cost of living in America jumped by the largest amount in 13 years as price increases spread more widely across the US economy. The government recorded its CPI index, or consumer price index, climbed 0.9% last month, which blew away economists' expectations of just 0.5%. The rate of inflation over the last 12 months in June climbed 5.4% from 5.5% even. The last time prices rose that fast was in 2008 when oil hit a record $150 a barrel. Prices also surged in the wholesale market again in June, further evidence that inflation at the consumer level is unlikely to subside anytime soon. The Labor Department reported its PPI index, or producer price index, jumped 1% last month, which is just almost double the forecast from economists. The annualized pace of wholesale inflation surged to 7.3% from 6.6% in May. The Federal Reserve Beige Book, which is a collection of anecdotal reports from each Fed members bank, stated a, quote, robust U.S. economy is strengthening, but it's also grappling with shortage and higher inflation. The U.S. economy strengthened further from late May to early July, displaying moderate to robust growth, the Beige Book said. Furthermore, supply-side disruptions became more widespread, including shortages of material and labor, delivery delays, and low inventories of many consumer goods. Businesses told the Fed they're not sure when they'll be able to ramp up production to satisfy the demand. They still can't get many supplies on time, and many open jobs are going unfilled. The outlook for demand improved further, but many contacts express uncertainty and pessimism over the easing of supply constraints, the survey said. And finally, with the worst of the coronavirus epidemic in the rearview mirror, many employers have pushing employees to return to the office. Surprising perhaps to no one, it turns out many workers would rather work from home still. According to LinkedIn's Workforce Confidence Index, employers in the sales, software and IT, transportation and logistics, and legal sectors were most likely to allow employees to continue working from home. but workers in the public administration and education are most likely to be forced to return to the in-person daily grind. Well, that's all for today. I hope everybody has a great week, had a good weekend, and we'll talk to you next week. Take care.